Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we are taking a look at three safe haven style tech stocks that investors might want to think about buying amid the coronavirus market chaos. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So as many of you know at this point already, the coronavirus sell-off saw the 11-year bull market come to an end at light speed, with the Dow, the S&P 500, and the NASDAQ all now down over 30% from their mid-February highs. And the selling and volatility look poised to remain amid the increasing uncertainty. And at this point, the sell-off isn't that hard to understand because no one knows the extent of the economic damage that the novel coronavirus will have as more and more economic activity comes to a halt. And then on Monday, this selling continued. So as of 10:30 a.m. Eastern, the Dow Jones Industrial Average was down about 4%. The S&P 500 was down also about 4%, and the NASDAQ was down around 3% as of 10:30 a.m. Eastern on Monday. So now the question is whether or not the worst is over. And some analysts obviously think the worst is over, and some think not. And simply based on the fact that the S&P 500 is now down about 32% from its February peaks. But if you look back to the two most recent big crises in the broader economy and the stock market, the stocks fell about 57% during the financial crisis and 49% after the dot-com bubble burst in 2000 before beginning to rebound. And obviously the governments around the world and people have taken measures to flatten the curve. This includes many Americans staying in their homes, the closing of restaurants and bars, no events really of any kind anymore. The economy, as I've said, is sort of coming to as much of a halt as you can without actually stopping. So with that said, some economists are saying to put a floor on the current market route, some of the world's biggest investors say there needs to be about three things to happen. We need better information on the scale of the coronavirus pandemic, which we still don't really know at this point. And then we need more powerful support from the government and more forceful interventions in the market. So with that said, we have seen the Fed cut its benchmark interest rate already to near zero, and it plans to continue to ramp up bond buying as it tries to boost liquidity. And then we saw the Fed on Monday, so this morning, said essentially it would buy unlimited amounts of treasuries and mortgage-backed securities in what many have already dubbed Fed Reserve Chairman Jerome Powell's whatever it takes moment. They're just going to try to do whatever it takes to keep the U.S. economy moving during this period and relaxing liquidity and getting people money when they need it. And then we saw on Sunday the Senate Democrats blocked a $1.3 trillion rescue package after a dispute with Republicans over corporate bailout provisions and aid to dislocated workers. So lawmakers and administration officials are still hoping to reach an agreement of some point, and both chambers of Congress are eventually going to have to approve it, and we are going to see Congress convene again at noon on Monday, so we'll see if anything comes from that. So with all of this said, clearly uncertainty remains king at the moment. So we're going to take a look at three stocks that investors might want to consider as sort of safe haven style investments at the moment. And we're going to start off by taking a look at Amazon. The stock has fallen over the last month, along with a lot of the market. However, the company's core business, which is e-commerce and cloud computing, do seem tailor-made to withstand the current market conditions. So if we look back all the way to February 17th, another tech giant, Apple, helped warn Wall Street that the spreading coronavirus was going to hurt its revenue growth in China. And since then, things have obviously changed pretty dramatically. So we have Nike and Apple closing their storefronts amid the social distancing push. And then meanwhile, the Seattle e-commerce giant, which is Amazon, announced last week that it actually, instead of closing shop, plans to hire an additional 100,000 employees in the US. The move comes as millions of people stay inside, and this could get obviously even worse as California, New York, and Illinois and more states are now having stricter stay-at-home rules. So the basic premise here is that Amazon's core e-commerce business is perfect for this stay-at-home style world we're living in the moment. So if we look at their core business, which is that core e-commerce business, which includes online sales and its third-party seller services, it accounted for around 72% of total fourth quarter revenue. Meanwhile, its prime heavy subscription revenue accounted for about 6% of quarterly sales, while its AWS cloud computing business made up nearly 12%. So about 90% of its business overall is coming from what we would consider online based things, because its fastest growing segment actually in the fourth quarter was its digital advertising heavy other unit. And that division jumped to 41% as Amazon now competes against Google and Facebook for digital advertising supremacy. So with all that said, clearly Amazon's diverse portfolio seems pretty well equipped to outperform the broader economy, if not really thrive during this coronavirus period. And then obviously looking forward, Amazon seems like a longer term bet when we come out of this coronavirus downturn, which we will at some point. It just depends on when that is at this moment. So now we're going to look at some other fundamentals for Amazon. We saw, if you looked back or were following the stock, Amazon did seem to not gain as much momentum as its other tech peers. This includes Apple, Microsoft, and some other giants. But the stock did start to pop late last year into February, but since then its shares are down about 12%, and this compares relatively favorably to the S&P 500, which has fallen 30%, as we mentioned, about 32% since then. So Amazon stock closed regular trading Friday down around 15% off its 52-week highs, and on top of that, it's trading at about 2.7 times forward 12-month sales estimates. And this marks a discount over its own one-year high of about 3.4 and its 2.9 median. And it also helps put Amazon right in line with the S&P 500's average and way below Alibaba, which is trading at about 4.7 times sales, and Apple, which is trading at about 3.6 times sales. So Amazon stock is sitting well below its 52-week highs, about 52% below its 52-week highs, or 15% below its 52-week highs, and it's trading at about 2.7 times forward sales, which is a major discount compared to Apple's 3.6, and it's trading at about the S&P 500 average, which is really solid for Amazon. And then, as I mentioned just recently, that Amazon did fail to gain a lot of momentum that some of the big tech stocks saw in 2019. And this came based on the fact that a lot of investors were a little worried that Amazon was, its profits were taking a bit of a hit, but that was because Amazon was spending heavily to reduce its prime shipping to 1 day down from 2. And this move was made to help it fight long-term against Target and Walmart and the other traditional retailers that are ramping up their own e-commerce and delivery businesses. And now looking ahead, our Zacks estimates are calling for Amazon's fiscal 2020 revenue to jump about 19%. And then if we look ahead to 2021, we're expecting sales to climb another 17% or nearly $60 billion above our current year estimate to $392 billion. And then on the bottom line, we're calling for Amazon's adjusted 2020 earnings to climb about 20%, with 2021 set to soar 50% above our current year estimate. So some solid top and bottom line growth for Amazon is what we're calling for. And Amazon's earning estimate revisions have remained heavily positive despite the current market conditions. This helps Amazon earn a Zacks rank number 2 buy at the moment. And obviously, investors need to think long and hard before they decide to buy any stocks at the moment, because Amazon doesn't pay a dividend to help provide any income amid this downturn. And obviously, we don't know if we're at a bottom yet, we could have longer to go, or we could be on our way out of it. Who really knows at this point until we see some end in sight to the coronavirus spread. But think about Amazon's business, that one of the other big part of their businesses that I didn't even talk about is their streaming service, which competes against Netflix and Disney and Apple for the future of entertainment. So now might not be a bad time for longer term investors, especially to consider buying Amazon stock, which their business model seems kind of tailor-made if anyone can be prepared for this kind of economic environment. But it seems kind of ready for the coronavirus stay-at-home style economy we're living in at the moment. And as of about 10:30 a.m. Monday morning, Amazon stock was down about 0.5%. And now we're going to dive into another big tech stock, and that is Intel, and see why that might be worth buying at the moment. So Intel is the largest semiconductor maker in the US by revenue. The historic chip powerhouse topped our fourth quarter estimates back in late January. This was driven by data center and PC demand. And then Intel also upped its guidance and noted that it's set to benefit from the ongoing expansion of cloud computing and more. And Intel is also set to expand and grow just for years to come as part of the broader technological revolution that chips help support. And Intel might obviously not be as flashy of a name as some of its growth-focused peers at this moment, like NVIDIA and other big name chip stocks, but it's that stability that might actually be better suited for investors at the moment. And also, obviously, the company is preparing for the future. In just last week, the company announced that it's ready to release its latest, most powerful neuromorphic research system, which is providing the computational capacity of 100 million neurons. So the basic premise here is that Intel noted that its cloud-based system will be made available to members of its Intel neuromorphic research community, and they're going to slowly roll this out. And investors, all you really need to know, it's very complex. You can look this up. Some of it's a little over my head as well. Investors should note that the neuromorphic computing systems, they try to mimic and simulate the way human brains work, and neuromorphic chips are expected to lead to faster and more energy efficient computing. Tech research firm Gartner expects that neuromorphic chips will be the predominant computing architecture for advanced forms of AI by 2025. So Intel stock is actually up relatively big today. They were up about 5% as of 10:30 a.m. on Monday. So obviously, and this is news they rolled out late last week. So this could be big for Intel going forward. And then in terms of some other fundamentals, Intel's free cash flow continues to grow steadily. In fiscal 2019, the firm returned roughly $19 billion to shareholders through dividends and buybacks. And we should note that last quarter, Intel announced that it raised its dividend by 5% on an annualized basis. And Intel's dividend yield currently rests at about 2.8%. This easily tops the 10-year U.S. Treasury note, which was at about 0.70%. Monday morning, it tops the S&P 500's average of about 2.3%, and it tops Apple's at about 1.25% at the moment as well. So a solid dividend payer, along with some longer-term ability for the company to grow. And then in terms of valuation, Intel is trading at about 10 times forward 12-month earnings estimates, which marks a discount compared to its industry's 12.5 times average. So the bottom line here is Intel has seen some negative earnings revisions recently. This helps it hold a Zacks rank number 3 hold. But as I mentioned, the stock jumped about 5% on Monday when much of the market was falling yet again. Yet, despite this climb, it's still trading down roughly 30% from its recent highs. So you could still, any longer term investors might see now as a solid time to think about buying Intel. But as I said, with Amazon and all of these stocks anyone's considering buying at the moment, is there could still be more room to fall, but longer term investors have a different horizon on investing. So if you're thinking 6, 12 months, or even 5 years from now, maybe Amazon and Intel are worth it at the moment. But then Intel, unlike Amazon, does pay a dividend, so you're getting that income amid the current economic conditions. And then we're going to close by taking a look at Microsoft. And Microsoft was a firm that, along with Apple, warned Wall Street in February that it was likely to fall short of its revenue guidance on the more personal computing segment. And this was due to setbacks in China. But luckily for investors, Microsoft said at the time that its Q3 guidance remained unchanged for its other units. And this is a good sign, since Microsoft's cloud computing segment has driven growth and price performance for the last several years. For instance, Intelligent Cloud revenue was up 27% last quarter, and going forward, its expanding cloud computing unit looks poised to continue to drive growth going forward and help Microsoft continue to adapt within this rapidly changing tech space. So looking ahead, our estimates are calling for Microsoft's adjusted earnings to climb 18% this year, and then another about 12.5% in 2021. And then meanwhile, sales are expected to climb 13% this year and then 12% the following year, which are both really impressive figures for a company of its size and age. And despite seeing a few downward estimate revisions recently, Microsoft's overall earnings revision picture remains heavily positive, and this helps Microsoft hold a Zacks rank #1 strong buy at the moment. And then along with that, the stock is part of a highly ranked Zacks industry, and its dividend yield rests at about 1.5% at the moment, which, as we just mentioned with Intel, this helps it easily top the 10-year US Treasury at about 0.7%, and Apple payout as well. And then we should note that Microsoft consistently raises their quarterly dividend over the years, and they approved a new share repurchase program last fall. And as of this morning, the stock was trading at down about 28% from its 52-week highs at around $136 per share. And it's gonna sound a little repetitive, but once again, anyone who's thinking about buying Microsoft as a longer-term investment, now might be the time. But obviously, stocks could continue to go down, but Microsoft pays a dividend. Its cloud computing is where its growth is coming from, and it looks to be a solid longer-term investment that Zacks ranked #1 strong buy at the moment, as its earnings revision picture remains heavily positive. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.